Welcome, everyone. I'm Bill Jonason. I'm co-chair of the M&A group here in Minneapolis, and my fellow co-chair, Lane Smith, is hopefully watching by video from Salt Lake City. And we appreciate all of you coming today. This is a important and timely topic. We're seeing more and more rep and warranty insurance and deals. We did a program on this a few years ago, but even in the last few years, things have evolved. The premiums have been changing. We're seeing more policies on the sell side in addition to the buy side. So we're happy to have this panel here with us today to talk to us about that. Our special guest is Leah Coakley, and Leah is a vice president in the Transactional Liability Solutions Group at Lockton Companies. She's been there for 4.5 years and is active in this market and understands the policies and the premiums and who's doing what in this arena. She also spent 9 years prior to that underwriting transactional liability insurance and analyzing M&A agreements and looking at tax risks and related concepts. So we're pleased to have Leah here. She comes from Lockton's New York office. Dan Brown is on the other side, and Dan is in our trial group here, and Dan has become kind of our go-to person for rep and warranty policies and helping the client understand what do these terms mean, what's my coverage, what's my exposure, and then also helping to negotiate the actual terms and conditions with the underwriter. And John Van Horn in the middle is like me, an M&A lawyer, kind of in the trenches negotiating the terms of the acquisition agreement or sale agreement or merger agreement. And more, as I mentioned, and as you know, we're seeing rep and warranty insurance involved. And so the three of them can share their experiences and kind of nuances and kind of what they're seeing more of these days. So with that, I welcome the panel. Thank you.
Hey, thanks, Bill. Thanks to everyone out there for coming. And to echo what Bill said, special thanks. Dan and I are extraordinarily grateful to Leah, both for taking the time and traveling to be with us here in person today, and then also grateful for your contributions in helping us put this together. So before I forget, a hearty thank you from everyone here. To echo something Bill said in the intro, just to set the table, if you look back the last 10 years, I don't think it's even debatable that the headline about M&A markets is really, the retrenchment in the M&A market space following the Lehman Brothers failure 10 years ago, and then just the explosion in growth of M&A volumes coming out of that retrenchment, and then the extraordinary valuations that we've been seeing in the marketplace and in this boom market. But taking that headline aside, kind of for those of us that, as Bill puts it, that are in the trenches and executing deals and deal kind of technology and terms, I think the biggest development in the marketplace has been the rise in the use of representation and warranty insurance as a risk management and risk allocation tool in M&A deals. Dan and I, as Bill mentioned, were on a panel here 3.5 years ago, and at that time, it was really a nuts and bolts reps and warranty 101 program. The genesis then was some emerging trends we thought we were seeing in the marketplace, and some thought that this could emerge into sort of a from a niche product into more of a mainstream deal tool, and that's exactly what's happened. So, today our purpose is a little bit different. We'll spend a little bit of time with kind of an overview, a review of the basics, but our working assumption is that many of you have some or even extensive experience in using rep and warranty insurance in your deals. So after that brief refresher, what we really intend to do is dive into our three principal topics, which are first looking at some trends that we've been seeing in the marketplace, both in terms of carrier growth, volume of deals covered by rep and warranty insurance, and then also in terms of the evolution of some key policy terms that we've seen over the past few years. Second, we'd like to cover some key points in the process, process for underwriting rep and warranty insurance and the policy in your deal, and we'll focus on a couple key milestones in that process. And then finally, we'll wrap it up and hope to leave a little bit of time for questions after that, but have a discussion around what we've been, as this product's matured, we're at a point where we are starting to see, and market professionals are starting to see some claims volume that gives, some statistically significant insight into what's going on and how claims are administered. So with that, we'll just jump into kind of just a brief review of the basics. Rep and warranty insurance covers losses of the buyer that are sustained as breaches of the seller's representations and warranties that are contained in the purchase agreement. And as the slide makes reference to, it's become pretty customary in the policies that they'll also cover a standalone indemnity for pre-closing tax liability. One note here, today we're talking about representation and warranty insurance, but as Leah can tell you, that's just one type of transactional liability insurance product, and there are, on the slide you'll see some information about other types of common transactional liability solutions that we see in the marketplace. I think it's fair to say that a lot of we can attribute the rise in popularity and growth of this product in large part to the advantage that it provides to sellers over the traditional seller escrow method for covering, seller liability for breaches of reps and warranties. So, instead of the old seller escrow of 10 to 20% of the purchase price, which would be deferred or placed into escrow and then would be used to cover buyer claims for breaches of reps and warranties, the use of third-party insurance allows that escrow to be significantly decreased, as low as 1% of the purchase price, or even in some cases offers the opportunity for kind of a seller walk-away, seller without any responsibility or liability for post-closing for breaches of the reps and warranties. But as this slide indicates, as the product has evolved and been more widely adopted, people have recognized that it does provide some advantage to buyers as well, and some of those are highlighted here. And the ability to get a longer survival period than had become kind of the market norm for seller escrows, and then also, there are some kind of key terms around or limitations around indemnification recovery that were always, at a worst, you kind of ended up at a seller-friendly position. At the, best case from the buy side, you'd end up with kind of a protracted, tricky negotiation around some really, kind of lawyery points around materiality scrape and how losses are defined. And the policies have really evolved to the point where they are at a more buyer-friendly set of terms than a lot of buyers had been able to have negotiated as against a seller escrow.
John, can I interrupt for just one moment on just a real quick practice pointer here, and this sort of comes from my opportunity to negotiate some with the underwriters. Maybe you could go back once just to the very first thing on here that relates to survival and policy periods compared to what you can get on the insurance. Do make sure that you're either doing one of two things. You're either using the definitions in your transaction document to then describe those policy periods, or you're paying an awful lot of attention to if the policy is separately setting out what it considers to be the fundamental representations versus whether or not those are just general representations. We've had a couple of instances where a little late in the game, we're still working with the insurance company to make sure that you're matching up what the fundamental representations are, the way they're described in the policy versus the way they might have changed in the transaction document. So just as that practice pointer, that's a real key place to be making sure that you're tracking all the way through the deal.
Great. So maybe just to wrap up our real quick sprint through kind of the review, Leah, I think we provided a really helpful example here that I think kind of illustrates how this might be deployed in a, kind of a typical situation.
Sure. So, yeah, for anyone who hasn't dealt a lot with these policies, I think this visual gives a good illustration on how the policies work. So if you see what's in orange or brown, that's the policy, and the limit is that $10 million amount, and the policy term is that 6 years on the horizontal line. But the example is a $100 million deal. So typically buyers are looking for around a 10% of deal size deal protection. So historically, they'd be asking the seller to put $10 million in escrow to be there for losses from breaches of reps and warranties. Now the buyer buys a $10 million reps and warranties policy, so the seller doesn't have to put that money in escrow. And we'll talk about instances where there's no seller indemnity, but more commonly, buyers are still successful in getting the seller to provide a small, 50 basis point seller indemnity, excess of this 50 basis point buyer deductible in the purchase agreement. So you see the 500,000, it may be hard to see up here, but also on your sheet. So the way a typical policy is structured is the buyer would be on the hook for the first $500,000 of loss incurred from breaches of reps and warranties. Then the seller would be on the hook for the next 500,000, and then the $10 million policy would sit excess of that. You'll see after that 12-month mark, the policy retention drops down. The carriers acknowledge that once the seller's indemnity goes away after 12 months, the risk also declines, so they're willing to drop that 1% of deal size policy retention down to 0.5%, and the policy term gets to the point that Dan was just mentioning. Your general reps are going to survive for 3 years, so that 12-month drop down.
Technology.
Did not realize. So that one of the benefits under the reps policy is instead of the 12 to 18 months that you're getting as a survival for your general reps, you're now getting them covered for 3 years under the reps and warranties policy. Reason being that they see a lot of the risk going away after 12 to 18 months, so they're just happy to cover them for 3 years. And then you have the longer 6-year survival period for your fundamental reps. So that's usually title and capitalization, authority to sell the shares, along with tax matters, and we sometimes see benefits thrown in there. And to Dan's point, like if it's an IP deal, sometimes you want the intellectual property reps to also constitute a fundamental rep. So that's just something to think about when we're looking at the quotes to make sure that the carrier is contemplating that longer survival period for the reps that are critical to the deal.
And I would say, in comparing, I think the idea of a deductible basket that had put the buyer at risk for a certain, percentage of losses before a seller indemnity kicked in, I mean, that's not a new concept. So, splitting the insurance retention in this way that makes the buyer responsible for a basket amount and then puts, the seller on the hook for a limited indemnity up to the exhaustion of the retention. That's the real difference, is just, cramming down that amount that the seller is really responsible for before and then having a third-party insurer sort of step into that risk after the, that limited escrow is gone. So I know you wanted to make one note on the buy side, sell side distinction. I mean, and the observation you see from the slide, the vast majority of the policies that are written here are buyer side policies, but maybe it doesn't have to be that way. It might not be that way forever. But any observations there?
So this example is a buyer side policy, and the reason they're almost always buyer side policies is because the whole strategic use of the policy is for the seller not to have to put that money in escrow, and them not to have to worry about the indemnity or the policy. So it continues to be a seller's market, so that trend continues. Whenever the buyer has the upper hand, and if it tilts that way in the future, where it tends to be less of a seller's market, we will probably see more seller side policies, because the buyer will be able to say, you know, we're requiring 10% deal protection, and they'll still win the bid, which it's tough to do now. And then the seller will give them that indemnity and then buy a policy on their behalf that backstops the indemnity. So they would pay out to the buyer, and then the policy would reimburse them. And just one thing of note is that on the buyer side, which is the example we're going to go through with the process, you know, the underwriters are looking at their diligence reports and the diligence that they've done, which obviously they don't have the benefit of on the sell side. So on the sell side, they're really underwriting the information they get from the sellers and management on how the company's been run.
Right.
And I'll just mention, actually, Bill and I had experience about maybe April this year of working on a sell-side policy as well. There are a few differences just in terms of the way it works. So one really big one that everyone always hears about is the sell-side policy doesn't cover against the seller's fraud, whereas the buy-side policy would cover against the seller's fraud. I'll be a little more specific to say that the exclusion in a sell-side policy is fraud by the deal team, typically. So you're going to pay real close attention in a sell-side policy to who you're declaring to be that deal team, so that those folks' knowledge are the knowledge that really matters for that fraud exclusion.
Great. Well, thanks. And transitioning now to kind of some recent trends and developments in the marketplace and in policy terms. So, Leah, I'll turn it over to you, but I think, you know, Lockton's been collecting some data. There's data available elsewhere in the marketplace. You know, I read all this to kind of confirm, you know, what we're seeing anecdotally as deal lawyers is that, you know, that we're seeing this product used, you know, increasingly. We're seeing a lot more of it, you know, today than we were seeing 3 years ago. But why don't you walk us through kind of what you see in terms of market trends?
So as the product became a lot more accepted in the deal community, there were, you know, a lot of law firms working on behalf of the buyer, negotiating the policies and recognizing some, you know, shortfalls in how damages were covered, among other things. And the carriers responded and came closer to what the buyers and their counsel were requiring. And the product really started to take off about 3-4 years ago. And there's been exponential growth every year, which has caused a lot more carriers to come into the marketplace and rates to decline. So a few years ago, rates were almost always above 3%. Now we're seeing them closer to, you know, 2.8% and even a little bit lower at 2.6%.
So when you express the rates as a percentage, we're talking about a percentage of the coverage limit, right? So if you're purchasing, you know, $50 million of coverage, it's, you know, 2.8 to 3.2% of $50 million.
That's right. That's right. And then the retention amount is a percentage, this 1%, it's based on the enterprise value of the company. So if it's a $100 million enterprise value transaction, you'd have a $1 million retention, and that's the example we were looking at before. So on a $100 million deal with the $1 million retention, the buyer and seller would split in paying the amounts.
And kind of hand in hand with the reduction in, you know, the trend toward reduced premiums. I mean, that's the other key economic change that we've seen since Dan and I were sitting up here maybe 3.5 years ago. I think when we were here, we said, you know, the kind of the rule of thumb as to retention is 2% of enterprise value, and that gets split, you know, half and half by buyer and seller, 1% each, and that's really been cut in half, and that 1% retention is really now kind of the standard.
That's right. And on larger deals, say if they're over $500 million, and you're buying much higher limits for the policy, the retention can be closer to 0.75%. So this chart on the right just gives you a visual of the growth that Lockton has seen just in the reps and warranties policies that we've bound. So I would say 4 years ago, it seemed as though maybe 20% of middle market deals were using reps and warranties insurance. It seems now that that's well over 50%, could be closer to 70, 80. It seems that it's pretty commonly used on middle market deals, and as a standard, buyers just aren't very competitive with their bids if they're not telling the seller that they're buying a reps policy in lieu of the standard seller indemnity.
Yeah, I think one consequence of the entrant of new carriers into the marketplace is it has changed. There's I'm going to throw out during the course of this 3 or 4 kind of client questions that we get from clients routinely. One is how much is a premium? That's been answered. How much is a retention? You've covered that. One question we get pretty often is, well, what's the minimum policy size that you can get underwritten? And then, on the other end of it, what's the maximum policy limit you can, that can be underwritten in the marketplace? And I think as new entrants to the market have emerged, there's, that insurable range has kind of expanded. So how would you, how would you answer that question if you were to get it, like, what's the smallest we could insure, or what's the largest?
So deal sizes, when you get much less than $30 to $50 million in purchase price, the economics surrounding the limit that makes sense to purchase and minimum premiums, tend to get turned upside down. So I think 30 to 50 million deal size, purchasing a $3 to $5 million policy limit is on the lower end of what makes sense. When there are also on those smaller deals, it can tend to be more challenging when there are no audited financials and they're not doing the same level of diligence that is being done on the larger transactions. On the other end of the spectrum, larger deals, now there's up to $1 billion in limits in the marketplace where you would structure a policy where there's a primary carrier that underwrites the deal and excess players kind of tag along on their underwriting diligence and place excess follow form policies that just follow the coverage granted by the primary policy.
One more thing I'll mention, actually, just when you see the list of the current insurers there, you see a broadening list of folks. And one of the features that I think that actually has brought into the market is you've got more of a variety of folks, like an AIG who's been doing this for a long time, and their policy tends to be pretty well matured at this point. We have, when Dorsey works with AIG, for instance, we have a pretty good understanding of what that policy is going to look like. Whereas if you get some of the other entrants into the marketplace, maybe their underwriting process and their policies are not quite as matured. And that goes both ways. Sometimes you get really neat policies that are pretty simple and out there. We looked at a Great American one not that long ago where it was a pretty nice, simple policy. Whereas sometimes you look at them and you think, boy, I don't know if these folks have really thought all that through. So especially when you're looking at the various potentials for who might be your underwriter, what company you're going to work with, that's a great place for your broker to be helping tell you how much they really have vetted their own policy and their own process as they're going forward in that placement of the policy.
Mm-hmm.
Yeah, and then just circling back just for a second on kind of the lower, kind of the low end of an insurable deal. Sometimes it's kind of helpful to refocus clients on, rather than deal size, here's kind of the lowest policy limit that's really available in the marketplace. And if the choice is to kind of over-insure in some sense, insure at a policy limit that might be higher than you would have expected to get in a traditional seller escrow, we do see some buyers that are making that choice. I think Cam, looking at Cam, we worked on a deal not that long ago that was, maybe $15 million in deal value, and we were told, well, you really can't get a policy for anything less than a limit of about 5, and we went ahead, the buyer went ahead and got the $5 million policy there.
And often the seller will help pay the premium, so that always helps on the smaller deals where the cost is an issue.
The transition now to maybe some kind of changes in, how, two things, how the product's being used somewhat, and then in some of the common terms. Again, kind of flashing back to what you might have heard Dan and I say 3.5 years ago, was sort of this, the retention split, splitting the retention, responsibility for the retention between the buyer on the one hand and the seller. And I think what we were hearing from the carriers then was the carriers were much more comfortable with the idea of the seller having some, understanding it would be limited, but having some limited seller escrow up, so some seller skin in the game, that once the buyer's share of the retention had been eroded, that the sellers would be out of pocket for some losses before the policy kicked in. And one of the trends we've really seen develop in the intervening 3 years is the rise of kind of the NSI, or no seller indemnity deal, where you purchase the insurance and the buyer takes sole responsibility for the entire retention. So the 1% retention, the buyer's on the hook for all of that. And then once that retention's been fully eroded, then you're into the policy, no seller liability at all. And from a kind of a deal dynamic, kind of what we're seeing in terms of behavior in the marketplace, I'll say, is two things I've observed. One is really, and these really relate to kind of the auction situation, and I'm seeing more, structured auction processes for the sale of companies than I've ever seen before. In the structured auction, we're seeing a lot of buyers come in, maybe you're on the sell side, we're seeing buyers come in and maybe they're being presented with a bid auction purchase agreement that suggests a split in the these all go out with rep and warranty insurance as the primary backstop. But the bid draft, maybe the seller goes out with a draft that splits the responsibility for the retention between buyers and sellers. We'll see buyers come in and try to distinguish themselves by saying, no, we're going to give you a no seller indemnity deal. Sellers get a complete walk away here. We'll take the full risk of the retention and we'll shepherd this through underwriting. So we see aggressive buyers trying to distinguish themselves in that way. And then on the sell side in drafting the bid docs, I'm seeing a trend toward, again, I think maybe a year ago, there was some humility there, and you'd have the sellers like, we're not ready to propose a complete seller walk away here. We should really go out with a document that's a split retention and let the buyers react to that. And I'm seeing much more auctions go out with the bid draft. It's a flat out, no, what we're talking about here is a seller walk away. If you want some protection, buyer, you go ahead, get the insurance and bear the responsibility for the retention. So it's been a little bit of a shift in how some of the auctions are being positioned. So with that, Leah, what else are you seeing out there?
Yeah, and I would just, on the no seller indemnity point, we are, they can get done, and carriers aren't really charging more premium for the no seller indemnity deal. But, we do see, we'll get it quoted both ways, with and without seller indemnity. And often it's sometimes with following materiality scrapes and getting down into the, the details of underwriting and negotiating the policy, the carrier just pays a little bit more attention and gets a little bit more into the weeds when there's no seller indemnity, since the seller doesn't have any skin in the game there. So, and then moving on to other trends, seller rollover. So obviously, seller rollovers should be a favorable thing to the carriers, and it is. They like to see that management is going to stay on and is incentivized to assist in helping the company to keep performing well. But when there's a certain level of seller rollover, they just shy away from that moral hazard of insuring the seller for breaches of their own reps. So historically, it was really around 20% of go-forward equity in terms of seller rollover. That was the threshold where they'd require sellers to sign their own no claims declaration in connection with the policy. So essentially, to the extent the seller knew of a breach and the carrier can prove that, they exclude their portion of loss. So if it's 25% or whatever, they would just exclude 25% of loss if the seller knew about it. That threshold is moving closer to 30%. So, obviously it's not you don't like to have to ask the seller to sign a no claims declaration. So that trend has been good for us.
Dan, I know you had maybe an observation about, again, one of the other hot questions is, well, what kind of exclusions can I expect to see in the policy? Have you seen that evolution in kind of the exclusions to what's covered?
I have, and I'll say I've seen a real general trend, and then I'll be real specific about one particular exclusion I've seen. One general trend that I've seen is you're just getting more exclusions, maybe a little later in the process than you're used to. Every policy comes when you first get it with the brackets that say, and other deal-specific exclusions, and then as you're getting through the underwriting process, you're going to get those exclusions coming along. And I think there's a trend toward, especially some of the more mature underwriters like an AIG, sort of coming up with more exclusions than maybe we used to expect as we were coming along. One example of one that AIG is putting in almost everything now, and I don't know that they're all that unique in this regard, it relates to cyber risk. And what AIG is actually doing these days is they're starting their form policy with an exclusion for cyber, except to the extent that there is an underlying cyber policy in the target company, and then AIG will agree to be sitting excess and no broader than the cyber insurance that's already existing in the target company. I actually had a specific conversation with the AIG underwriters as to the rationale for that, and AIG said that they feel like there are some things, and cyber is one of them, where the underwriting is so specific and specialized that the folks who are doing the underwriting on a rep and warranty insurance policy don't feel like they've got a level of expertise to underwrite that cyber risk. And so they're actually just starting at the base level of, we're going to let somebody else have underwritten that, and we're only going to sit excess on that. And we've had some varying degrees of success in whether or not we can get that removed from AIG policies when they come through, and when we can't get that removed. And I'll dive in to say one more thing about that, which is that that's one of those that when you have an exclusion like that says we'll actually sit excess of a target company's insurance product, that is one that you are going to be thinking really hard about when you've got the difference between a buy-side policy and a sell-side policy. It was a specific issue that came up when we were working on our last sell-side policy, because the complaint I had with the underwriter in that instance was, well, once I sell the company, I don't control what the target company maintains for insurance anymore, buys for insurance anymore. And of course, most of the time, these provisions are going to say something like, if you don't maintain the insurance that we've all agreed to, then it's just excluded. Then the risk is excluded from there on out. So you are going to need to pay a lot of attention to that sort of thing. And frankly, I will say that I hope the market continues to move on that one, because I do think that cyber risk is one that we're paying a lot of attention to. And of course, if it's giving us heartburn on the transaction side, that's why it's giving insurance companies heartburn. But I'd also like to see us get to maybe a better spot where there's a little more sophisticated underwriting in the rep and warranty process, so insurers are taking that risk back on.
Yeah, and cyber is an interesting one because obviously, it's a hot topic right now, and companies are paying close attention to it. So I think as companies get better at understanding that risk and putting policies and procedures in place to manage the cybersecurity and the data security and cyber risk, then carriers will be able to get comfortable in underwriting. And it's certainly one that we are paying close attention to at the NBIL review stage. That's an acronym for their quote letters. And we'll go back to the carriers and ask them if they can consider removing that excess of and no broader than, whether it's on cyber or environmental. It's something that we ask them to reconsider at the stage that we're choosing to move forward with them. And sometimes it's just a matter of telling them a little bit more about the target company and why it's not why we think they're going to get comfortable with it.
Well, thanks. I think we have actually made the transition into the next topic, which is kind of the underwriting process and some pointers for getting the buyer that's writing that policy through underwriting. This slide addresses, another one of the frequently asked questions, which is, what is the process for underwriting, representation, warranty insurance? What's the timeline? This gives a helpful overview of that. What we're really focused on today is two of the milestones that are described in here, and wanted to talk a little bit, as we've gotten more experience with this, what we've found to be kind of key events in the life cycle here maybe. One is the choice of carrier and, once you've gotten the quotes back from the market, evaluating those quotes and the proposals, the end bills, the non-binding indication letters that the carriers submit, evaluating them and then making that choice of carrier. Because as Dan says, once you kind of start down the road with a carrier here, most of these deals are on a timeline that that's the horse you're going to ride. So that's an important evaluation at that stage, and it's not necessarily something I appreciated until I'd been through it a few times. And then the second is maybe just some tips about on the due diligence and with a focus on legal due diligence, some ways people can run their processes to kind of help make that underwriting process as smooth as possible. So with that, Leah, I'll turn it over to you.
So we typically get engaged when the buyer's bidding on a company, and sometimes we'll just provide a desk quote to give them an idea of the terms to expect, and we'll get quotes once they're exclusive on the deal, unless it's maybe a hairy deal they're working on and we want to get some carrier feedback before they're exclusive, then we'll get quotes at that stage. It takes 2 to 3 days to get quotes from the carriers, and there's no cost to get quotes. We just need to share the draft purchase agreement, information memorandum, and financial statements to get quotes. And we go to the, as you saw, there's almost 20 carriers now. So we try to limit it to the 8 to 10 carriers that we think are the best fit for the deal and that we've been having good experiences with. And once we get those quotes back, we narrow it down to 4 or 5 carriers, to present a summary of the quotes to the client and their counsel, and we set up a call to go through those terms. We're really focused on what they've listed as their deal-specific exclusions, like wage and hour or cyber risk or classification of independent contractors, or if they've had those just as a heightened risk. So they'll have a list of heightened risks, which is the areas they'll be focused on based on their understanding of the target company. And that's something we talk through with the deal team and their counsel, and we try to get more information to get a sense of, will this end up as an exclusion, or do we think the carrier will get comfortable? And we'll go back to carriers to fine tune their quotes, including maybe deleting some heightened risks or moving deal specific exclusions to a heightened risk area, or that example of excess cyber insurance, we'll get them to try to get them to remove that.
And that is one, I want to pause there on that for just a second, because that is what you'll see in the indications is they'll put out, here's the exclusions that we expect to put into the policy, and then there'll be, areas of heightened concern. And is there, and that, the first time through that, I'm trying, what does that mean for us? I mean, you could, on the one extreme, you could take the view, let's just treat these as de facto exclusions and assume they will end up being excluded in the policy, or does it really mean we need to do some extra diligence around this, or, does this mean the same thing for every, does it have a universal meaning among carriers, or do the carriers treat that differently? How do you advise clients when you're walking them through that list?
So some carriers err on the side of, throwing in the kitchen sink with the heightened risks, and some are very sophisticated underwriters, bless you, and narrow their exclusions to what they're really concerned about. They have a good understanding of the target business and the exposures for that industry, and try to narrow the heightened risks. But it's also good to have, just see what other carriers have listed so that we can talk through everything with the client and there's no surprises later on in the underwriting process. But we do know what carriers are more sensitive to certain areas of risk, whether it be environmental or wage and hour. And our carrier selection process takes all of that into account. It's also helpful, sometimes the law firm on the deal or the client will have worked with the carrier and those relationships do help to create a smoother underwriting process.
Yep, I'm going to chime in to say just a shout out to your broker at this point, because this really is, in my way of thinking, one of the most important functions, and you do a lot of them, so don't get me wrong, but I have had underwriters tell me late in the game that the answer was, I don't know why you're complaining about this or that exclusion, because it was in our indication. And so really sort of shutting the door on any further due diligence toward getting comfort with that underwriter at that point. And so being able to know that up front from your broker and the experience they have with those folks when you're picking that insurance company in the first place is just an invaluable part of that. So you've got that experience and when they say exclusion, they mean subject to getting comfort, or when these folks say exclusion, the answer is, no, that is going to be an exclusion on the policy.
And that's why it's definitely important to just talk through those issues up front and get a good sense of where the carrier's likely to come out on them, and maybe the client wasn't thinking of doing diligence in that area, and so if we get that out in the open early on in the process, they can engage someone to do that diligence, because that's all the carrier wants.
And that's a good lead into the last point on the slide is really, how one of the observations from the trenches is really how and I'm thinking of legal due diligence because that's what we're most involved in, but I think it's true of the diligence overall is how the emergence of this product has changed legal due diligence somewhat. And, part of it, I tend to work mostly with strategics, and I think that, the growth of this product being driven really by private equity and financial buyers, kind of the carriers' sort of view of the ideal diligence process was really driven by how financial buyers do due diligence, which is hire a bunch of third-party vendors to go out there and do it, produce these, glossy, kind of professional-looking, very detailed reports. And that just sort of set, I think, carrier expectations about what they're going to see in terms of diligence output in their underwriting process. And I think some of the strategics have had to rethink, their diligence. They had grown accustomed to doing diligence a certain way, had their own processes, maybe not as heavy reliance on outside vendors and more internal, maybe more informal kind of communicating of results of the legal due diligence. And I think there has been a little bit on the strategic side in, maybe the second time through an underwriting process, people are kind of adjusting some of their diligence process and some of the output to be more directed, hey, there's another audience here, the carrier, and let's address, some of these topics, as you say, come up on every underwriting call. Let's just get that addressed at the outset and into our report. Maybe we can avoid, some of the follow-ups in the underwriting. So claims, I think maybe we're reaching the end of my frequently asked questions list, but one question we got early on is, especially repeat player buyers in the marketplace, they knew what it was like to make, if there was a claim for a breach of representation or warranty and they were going against the seller escrow, I think sophisticated buyer parties had an idea of, all right, this is what the process is like when we have to make a claim against the seller for an escrow, and here's how here are the rules of engagement as far as how that arm wrestling occurs. And there was a bit of anxiety about the unknown is, well, how's life different if we're making a claim against a third-party insurer as against a seller and, against the pot of money that is in a dedicated escrow account. And over the years, some carriers, AIG probably the best known, and then, Lockton's been the broker community, including Lockton, has been gathering some information about, claims administration and claims data. And we know, over time, we just know more and more all the time about, what happens with the claims, on what basis the claims tend to be made, and how they end up shaking out. So, and I think you, Leah, have maybe a little bit of breaking news on this, because I think AIG just released some new data. So maybe you can walk through what you see.
Sure. So yeah, the data here is from AIG's claims study that they released last year, and just a few days ago they released an updated claims study. So that's available online, and I can also send it to John. I don't know if it can be distributed, but it's on a global basis. So it's Asia, Europe, Australia, and the U.S. and the findings seem to be consistent with what we see and others see, with financial statements continuing to be some of the most frequently breached reps and warranties. One thing in their news study I thought was interesting was just, we think of a lot of the claims, a large majority of them is coming up within the first year of the transaction. They said they have been seeing 45% of claims submitted after the first 12 months. So I thought that was interesting. And then they break it down by breach type by industry. So it's interesting to see what claims are breached by industry. Healthcare, which is a growing area for which reps and warranties can be obtained, and AIG has been one of the key markets there. They see compliance with laws frequently breached there, which makes sense. Tax reps, they frequently see breached for technology firms. So I'm not sure if that's sales and use tax or others. Manufacturing firms, which is a lot of, we've been seeing a lot of claims in the manufacturing sector. They see financial statements and breach of contracts, specifically inventory. We've been seeing a lot of inventory claims. And Dan and I were talking about this beforehand. Just, it is interesting on claims, and maybe Dan's had some experience here, but just there's an exclusion in the policy for losses arising that constitute a working capital adjustment under the purchase agreement. So there can be a fine line between what constitutes a working capital adjustment and is a financial statements breach outside of that. So there are forensic accountants getting involved both on the carrier side and on the client side, and that can be in the claims process, that determination of damages is really where we see a lot of the time being spent. It's usually pretty black and white to see if there's been a breach of a rep. But then when you get into the damages, it's more complicated. And then there's also a difference between getting through the claims process on a third-party claim versus a first-party claim. If there's a third-party claim, we see a lot of breach of contract reps. If there's been an issue with a customer and the buyer comes in and now they're having this issue with the customer contract, and but then they're trying to find out what's the actual loss. Are they losing the customer? Is it lost revenue? Is it for how long? So that's something that we've had to work through on the claims side for third-party breaches. And Dan?
Yeah, I'll chime in on that, and then another thought as well, so you're going to be paying a lot of attention to how you're, at the point at which you're now in that claims mode, you're going to be paying a lot of attention to the careful words you use about what exactly is it you're claiming, so that you're not inadvertently running afoul of those exclusions. I'll just take one. Before we got down here, I just went and took a look at an old policy we were looking at that said the collectibility of accounts receivable, for instance, was one that was excluded. And so if you happen to have that issue, then you're trying to decide, is that a balance sheet issue for me? Is that a net working capital issue for me? It might not be an insurance policy issue for me because of that exclusion. Is there some other way I'm going to be characterizing those damages? And so you're just going to be really thoughtful about which poison are you picking there and then who's going to be responsible for that based upon that. And I think that's not something that's uncommon. It comes up in a lot of instances where you're trying to decide, am I getting first dollar on a purchase price adjustment? Am I into my retention because I'm now going to be claiming against the policy? So just being strategic about the way that you're characterizing those losses when you're actually analyzing those claims. The other thing I wanted to say actually is you see on a chart like this that there clearly are claims being made against insurance policies in the rep and warranty field. I will tell you, having been continuing to look, there is still an absolute dearth of reported cases actually interpreting in the case law those rep and warranty policies. And that's true for maybe a couple of reasons. One is just that I think this is an area where things tend to get worked out a little more than, I do a lot of insurance litigation when I'm not doing rep and warranty placement and advice as well. And a lot of insurance claims, you sort of wind up getting into that boxing match right away. This doesn't seem to be as much one. The other issue that comes up is almost every rep and warranty policy has an arbitration clause of some kind or another in it. And so we're seeing an awful lot of this get resolved in unreported arbitrations. And so that's just something that creates a little bit more of a challenge because we don't maybe have that body of case law that we might have expected to have build up now and give us a critical mass of understanding as to how these policies are being interpreted.
And, well, I was just going to say, just piggybacking on that, in the claims handling process, we have seen both on the carrier side and the insured side, both of them getting more sophisticated in both how the claim is reported and how that information is presented to the carrier, and then the carrier responding to that. And has become more of a collaborative process and a discussion rather than the insured, we try to set the stage so that, it's not the insured thinking, oh, this is going to be denied, I need to go into this, really defensively. It's just we need to share the information with the carrier so they understand what's going on. And, if it's a third-party claim, it's keeping them apprised, having them bless, correspondence on it. But we have seen a lot of, the process going smoothly and working through claims.
Yep, it's a great additional add because this is a person who makes most of his living litigating against insurance companies, and I am telling you that my most important piece of advice on the claim side is keep your insurer informed as though you want them to remain your friend. Mm-hmm. Because if you're not behaving in that fashion with them, it only gets bad from there. So expect them to be your ally until they prove you wrong, especially in this area. Mm-hmm. Yep.
Yeah, and I think we're probably going to have to let the slide on the case study mostly speak for itself, but I think a lot of the points you both have been making are illustrated in there. And I would, again, another kind of view from the trenches is that, I tended for kind of straight up claims against seller escrow. Oftentimes, that initial case was kind of made or claim was made by the buy-side client without much advice or input from the lawyers at all. And I think this is just another, but where we were brought in, it was kind of a lot of, hey, check the purchase agreement, check the escrow agreement. Are we making a valid and timely notice under both of those contracts that has the stuff in it that the purchase agreement says it's supposed to have, an estimate of the amount of losses, a basis for the claim, kind of doing a little bit of a compliance check. And now you have another document that's in there. You have the policy and making sure that, is someone making a claim, that the claim notice you're submitting kind of checks all the boxes under all the relevant documentation. And I think as a result, I see people being a little more careful about how those claim notices are put together and a little bit more thoughtful. And again, it's the addition of kind of a new audience into the picture and tailoring those in a way that I hadn't necessarily seen before. So with that, we do have a couple minutes left for questions. So if anyone does have a question, raise your hand and let us know. All right, seeing none, I want to thank everyone for coming here and being here today. We appreciate it. Dan, I want to thank you. And Leah, thanks very much. We appreciate your help with this.
Pleasure.
See you next time.